So next here with table 3, the authors are doing the same 5 by 5 sort, only now they are controlling for the book to price, so the value factor. And then they're seeing how do the size, profitability, investment, and momentum factors, how are they affected by different levels of the value factor. And so from prior research, we know that the size factor, smaller companies tend to outperform larger companies, and we certainly see that here in the high to low. And we also see that here that monotonically, there is a monotonic relationship with size even after we control for the value factor. Although we see that this relationship only is statistically significant with the more value companies as opposed to the growth companies, because here we have the p-values are much smaller. Jointly, it doesn't seem to exist. From a profitability standpoint, prior research says that more profitable companies, which is by the return on assets, typically outperform lower profitability companies, but here in this case we see that's the case when we're looking at a zero cost portfolio, so the highest profitability minus the lowest profitability. We've got a positive difference here, but it doesn't seem to be a statistically significant monotonic relationship where the returns increase with each level of profitability across any of the book to price ratio portfolios. However, jointly we do see that it's statistically significant, which is interesting to see. So next we see the investment factor when controlled for the value factor. And in prior research, the companies that invest less in assets, which would be the low investment, tend to outperform the ones that invest in assets. And we see that's the case over here with the high minus low across all levels of the book to price ratio. However, the only one that tends to have a monotonic relationship where with each level of investment the return decreases is only with the ones that are extreme value companies. And taking a look at the momentum, where high momentum returns or high momentum stocks tend to outperform low momentum stocks in prior research. We see that's certainly the case here with the high minus the low, but we also see that statistically that looks like it's only the case with the with very growth related companies. Only the growth companies tend to have that monotonic relationship. And that's in line with prior research that shows that momentum companies tend to be growth companies. And next we're looking at profitability for each of the different factors. And so starting with the size factor, we see that certainly we're in line with smaller companies having larger returns across all the profitability quintiles. However, the MRP value is really inconclusive as far as monotonic relationship, and actually this is a very high p-value. So we can say there's not really a monotonic relationship with size when we control for the profitability of the firms. Going down to value, we see that certainly value-oriented companies outperform growth-oriented companies across all levels of profitability, but those don't seem to have a monotonic relationship at all. And next we look at investment, and we see here that the companies with the highest amount of investment underperform of the lowest amount of investment across all levels of profitability, but really the only one that's significant is the least profitable companies, and also the fourth quintile of profitability. Next we have momentum, where the highest momentum companies outperform the lowest momentum companies across all quintiles of profitability, but the only ones that have a monotonic relationship tends to be the least profitable companies. But we see this joint MRP values very significant. So we can say in most cases, momentum has a monotonic relationship as the past 6-month returns increased. And if we were to look at these in total, the highest returns tend to be this 14.45 and this 15.54, where basically the least profitable companies with the least amount of investment has a very high return, and the least profitable companies with the highest momentum tend to have really good returns. And also we have here almost an anomaly, this 1.85%, where, but this is in line with prior studies as well, where the least profitable companies that have the highest amount of investment tend to return the least. So it might be a good strategy to avoid those types of companies altogether.